think we have started. There we go. Now we've started. All right. So welcome everybody. It's July 23, 2026. This is the live Edge discussion. Thank you for being here. I'm Tim Quast, and I'm solo. Brian Wilson is somewhere in Nicaragua. I think he is. Brian is a good soul. He goes and serves. He goes and donates his time. So he's down there building houses or something. That's what so he'll be back, I think, Tuesday. Which means if I miss something, just interrupt me. So ground rules, if you haven't done this before, interrupt me, ask questions, and if you would mute yourself while we're talking. So I've got a dog back here somewhere who may show up during this thing, but that's what you don't want to have. Okay, so if you just joined, yes, our platform is down, but it's not us. It's Microsoft Azure, and I'm keeping an eye right here in the corner, and it's not resolved yet, which means I can't even show you Edge, but I don't really need to. I know what we want to cover today. Let me just get to this. Okay, so here's what I want to cover first. We talk about the big things. Demand and supply. I had a discussion with one of the big. We're working on another partner, and I had a discussion with several people from one of the big trading platforms yesterday. And what I emphasize is there is nothing simpler than demand and supply. And technical signals are older than I am, and I'm old. I feel like those things need to be updated. And I know many of you are very good at using them. I get that. Brad, I would call you an expert at those things. And, you can make it work, but you are in a minority, right? It's very difficult to use technical signals in a mathematical market. There are certainly things that you can see, but to me, demand and supply are very simple. So, is it? I haven't seen. Okay. Thank you, Dan. I wonder if everything is back up. I'm going to check one. Let's see. Aha. Yep. I see it now too. Okay. That's good news. All right. So I can bring thank you, Dan. Appreciate that. Thanks for keeping an eye. Okay, well, that will make things a little bit easier because now I can go to the supportive data. So number one, we wrote a number of times about this that and who knows whether this will just be a little swale in the market, but I do think it's telling that we could use market structure to understand that in June, institutional investors slowed flows to the market and began to withdraw. Well, how would you know? You think, well, you just wait for the prices to go down, but they didn't, right? The market didn't move. That's not the only signal. But the question is, well, how would you see that? How would you know that flows slowed? Well, one of the things that we like to look at, let me share my screen. As you know, if you do this regularly, we say, broad market sentiment, demand and supply, the broad market, that's one of them. Context, there's a cadence and calendar to the market. There are benchmarks, there are guideposts along the way that you want to be aware of. And then divergences. There's 6 in the momentum portfolio, 6 in low volatility. That alone tells you, well, there's nothing there. It's looking at 3,000 stocks and coming up with 6 each. That's it. I realize we screen very rigorously to have high quality stocks in those portfolios. And then here, same data, but with probabilities in the daily trading ideas. That's not very, it's not much. So we know right away there's a signal that's telling us to be careful. If you keep track of SPY, that's another thing. Broad sentiment, context, divergences, and the one ETF we have on the platform could be IVV, could be VOO. It's just that SPY is the most liquid of the 3. It's no longer the largest, but it's the most liquid. And so here was the issue. Right back here at June options expirations, demand dipped. Right? Well, when was the last time that happened to SPY? Remember, ETFs will be at 5. If you tried to use ETFs to understand demand and supply in the market, you would fail. That's why we don't have them on the platform, because they are by nature and by definition tracking instruments that are arbitraged to the middle. Well, what's in the middle? 5. right? They will almost always be 5 because they depend on an underlying basket of stocks for prices. So if a broker dealer says, here's the S&P 500 represented by SPY, but the basket of stocks we're going to trade are, I'm just picking them randomly. Walmart, Nvidia, I'm just pulling this out of the air. Aptiv, Tyson, and let's pick another giant one, Bristol Myers Squibb, and that will be our basket. SPY will derive its price from that. And you say, well, no, it derives its price from 500 of them. No, it doesn't. It's going to be some statistical sample of that 500s, whatever is on hand that is in that basket, which we do not know. Right? That the only people who know what's in the basket, and I'm going to talk to right after this, I'm going to talk to the head of the data products group at the DTCC, the Depository Trust and Clearing Corp, good friend of mine. And they're the ones who control that data, right? They're the ones who run what's called the NSCC, the National Securities Clearing Corp, in which those baskets move. And only the participants, the two parties to it, and the data providers know what's actually in the basket. And so, long-winded point out of this is it's a proxy. So it's always going to tell us, well, is demand slowing? And you could go all the way back a year ago, and there was only been excess demand, right? Little excess demand here, little excess demand here, big excess demand here. And then that's the first dip since I have to go back all the way to April of 2025, right? Here was the last time we had a big breakdown, but we had a little weakening here, little weakening here, but nothing all this time until here. Okay, well, there's the signal. That tells you, and when did it occur? At options expirations, right at June, quarterly rebalances for the S&P 500 and quad witching, when index options and futures both expire. Well, that's pretty important to know. You could study all the fundamentals, all the technical signals. I don't know. Maybe you would find it. I don't know the answer to that. But that is not technically or fundamentally driven. It is driven by flows. And so it was the tell. That was just one tell. The other, big one for me is that our model portfolio stopped working June 1, basically. So we had this pounding return up over 50% year to date, and suddenly it stopped working. And what does it follow? Passive money. Why? Because passive assets are 65% of assets under management now. They far surpass actively managed assets. Round numbers, they're all big, but 16 trillion in actively managed regulated retirement accounts, 16 trillion in ETFs, and 16 trillion in index funds. So 32 trillion that is effectively passive, and 16 trillion that isn't. I will do the math on that. It's about 65-35 split-ish. So it's big. And so we looked, the focus passive model follows where passive money goes. Well, if it stops arriving in the market, what will happen to the portfolio? It will stop rising. It will start to recede. Now it's about 35%, right? So once it's down 10%, we step back from it. And so then we run other models, and we found that the contrarian model all of a sudden about June 1 produced massive returns. Well, it's up 48%. It doesn't help you if those returns have already occurred, I know. But the point of those models, and if you're a subscriber, you should use them for nothing else, if for nothing else, to understand what the money is doing. It will tell you. And so we then started to write, the market could roll over when? July expirations. Because if passive money, big institutions, let's just call them, they use prime brokers. Big broker dealers, there are only a handful of them now that execute almost all customer orders. There are thousands of brokers, but most of those are what are called introducing brokers. That is, they engage in brokerage, but they're using somebody else's platform. There are only, the certain number of self-clearing firms, and then the large broker dealers who are actually handling customer orders and can comply with all the rules. Like, it'll be B of A, Merrill Lynch, Goldman Sachs, Morgan Stanley, JP Morgan, Citi, and a handful of others. And so they will help institutional money move. They transfer risk. So the money moves, but you don't see it in the market. You can. I mean, we watch how prices behave relative to midpoint, and it hasn't been good for a while. I mean, more than half of the last 30 trading days are negative from the standpoint of how prices indicate buying or selling. Well, there's another tell, right? So, but we already know that money is moving. And then when it's done, all of a sudden it hits the market because the brokers then get rid of it. So they will carry it for a while. They're just providing a service. They don't care which direction things go. They're being paid to handle transactions. And then whatever is excess that they can't place, they dump and the market tips over and everybody goes, well, what number was it that Google and Tesla reported that wasn't good enough? No, that's not it. It's not how the market works. I mean, the fundamentals are an input, but it is not the core part of the market anymore. So that, to me, it's very important to understand those things. So summarizing, we look at SPY. There's a signal, and you should be aware, and you don't put more money to work. Right in here somewhere, I rebalanced my longer term portfolios for that reason. If the flow is slow, then you don't want as much exposure. It doesn't, you can't time it perfectly, but if you get signals that tell you, well, it's likely to decline, I reshuffled to 25% equities, all the rest in fixed income and when the time comes to change it, I'll change it back. But the signals, the signs will tell you. Then one other item that I wanted to talk about here is, I wrote about this today, that there is an enormous amount of volatility in the market. We've essentially all year, from January to August, the volatility of the stocks comprising broad sentiment has been 3%. Long run, it's 2%. So it's 50% higher, but the VIX doesn't show it. And you say, well, how would that happen? Well, maybe, okay, it's weighting, maybe whatever it is. And I think that's a core part of it, because if you have if you're an institutional money manager with a portfolio of stocks, you don't want a lot of standard deviation in that portfolio. That is, things that are bouncing around, causing, you could think of it this way. If you added up all the positions that you have in your portfolio and calibrated how much the prices change over a month, it shouldn't be more than 15%. That's kind of the target, standard deviation. So if you have things that are volatile, like tech, the whole tech sector is about 5.5% volatile. So if you're overexposed to tech in terms of dollars in your portfolio, you're also going to have to weight that with less volatile things. So if you're holding NVIDIA, let's say, NVIDIA is not that volatile anymore, but maybe it's not the right one to pick up. SanDisk, let's say SanDisk. So you're holding SanDisk, but to keep your portfolio at 15% standard deviation, you also have to own Walmart or whatever, right? Because Walmart's got a third of the volatility. So I may have to increase my exposure to those things. That's another thing you can look for. You start to look for fives. I run a fives portfolio. If you I'll show you here in a second. And if the broad measures are doing the same thing, what you get is a surface that looks very calm, while underneath it is very turgid. And then people try to consume the volatility in all that movement. 3%, I mean, it's what we do, right? You look for demand supply imbalances, the Hicks rule. You hit 10 and supply drops. What is the probability of a 2% or better return in the next 1 to 5 days? It's nearly 100%, all other things being equal. There are other factors that come into play. It doesn't work with everything. I'm talking about liquid stocks. But that principle works, right? So, but the point out of that is volatility. You want to try to capture volatility. Suppose flows slow, and there's a lot of volatility, and machines that are consuming that volatility, like Citadel and Hudson River Trading and so on, that buy all the retail order flow from you and me, they're doing that until it's gone. Now, what happens if the flows aren't continuing to come into the market and you've consumed all the spreads? Well, everything moves the same direction, and it's unlikely to be up. The market has a long-term bias up. I mean, if you took the long-term data for this green part of the graph, broad market sentiment, it's 5.4. And you can dump that data for the entire data set and track it. You could run 20-day, 50, you could run moving averages on it if you want to do that. But you will find that it averages 5.4. So, over the long run, volatility supports the market because machines will cross the spread and they make a lot of money doing that. And the market continues to rise. At certain points in time, those conditions begin to break down. And here's another one. You look at the long term. This is just what I think 30 trading day, I think, view of the data here. The trend in supply is down, but we've twice moved above that trend line, and both times have been a little bit rugged for the market. So it's another thing to look for. I don't know if this is going to be a change. One thing that is interesting here is, generally speaking, it's another thing you can calculate. The supply cycles run about 8 days. 8 days down, 8 days up. 8 days, not exactly, but if you took an average, that's what it would be. And there are long exceptions, like this was a very long exception, and the one preceding it was too. And now we have a change developing again. Like it didn't, one day it's not a trend, but you look at all those things and they're all signals to tell you, and they only take a few seconds to look at SPY, demand supply relationship, divergences, what do those look like? And you have a pretty clear picture of conditions in the market. It's equally important to protect yourself as it is to take advantage of demand supply imbalances and profit on those. Okay, so that's what I meant when I wrote, that the machines go around like Pac-Man. Probably there are people who don't even know what that is. Pac-Man consuming all the volatility, unaware that it can destabilize the market if flows slow, and they have. Now maybe they'll come back. We don't know. This is the first day clear of the July options expirations period, and oftentimes that's when the trouble arises. Because all through it, you could hedge, and then the brokers are finished assisting their customers, and then you see the effect. Now, I don't know. Maybe tomorrow we're back to normal. I do not know what will happen next. We just look at the data every day. So that covers what I intended to cover. There are other things I could talk about, but I wanted to focus on the big picture today. Yeah. Observations, or do you just want your time back? Any words of wisdom? I'm always looking for them. Steve, you look like you're ready to say something.
Yeah. How much of it being August creates this volatility or lack of volatility, the decline that you're seeing? Because every August is a dead month. So how do you take that into account?
Yeah, I don't know, Steve. It's a good point and a good question both. We used to say, as you and I know, that the saying was that in August, right, everybody went to Martha's Vineyard or whatever your thing was. You go to the shore. And from New York, you go to the Jersey Shore, and no one was at the office, and so trading was very slow. But a lot of the order flow now is automated. I mean, literally, call it 80% of it is automated, meaning it runs on a schedule. And so I don't know, but it's true that I think at least 2, maybe 3 of the preceding Augusts have been, particularly right at the beginning, really bad. So is there some logical or mathematical or other explanation for that? I don't know the answer. It can't be because all the traders are going to the Jersey Shore, because the stock market is basically a big algorithm. No.
Have you ever done a defense contractor portfolio, which would probably be doing pretty well over the last 4 to 6 months?
Have not. Have you? Have you done that?
No, I was just curious if you did.
But you're absolutely right. And we see them routinely showing up in the model portfolios. That happens a lot. Tells us, if we're following passive money, shows you where it's going. So I absolutely agree. And in that same vein, Barry, we have identified that it is demonstrable that passive investors do not just buy and sell the index. They clearly bias it to the best stuff. Can't blame them, right? Well, why wouldn't you? If you have the choice, you would do that. I mean, why would S&P drop CoStar and add Lumentum? Or maybe it was maybe that's the triple Q. So maybe it's Invesco I should be blaming. You know what? Well, because CoStar, I mean, what's wrong with CoStar? Well, it's down 60%. So well, you don't want stuff that's down. There you go. Tim Coughlin says PPA. There you go. That's a great thing. There's your tracker. PPA is the ETF for the defense contracting industry. But you're right. Oh, cool. That's been good.
Yeah.
Yep. PPA. Thank you, Tim. Anything else? Should we? We'll take our 4 minutes and run. Oh, Steve. Yes, please.
Do we still have any relationship to fundamentals to corporations and buying stocks?
Yeah. Well, yes. You know, and I have this
with all the algorithms.
Yeah. Yeah, I had lunch with one of our energy customers in the corporate business in downtown Denver yesterday, and of course they matter. I mean, there is still story. It's simply a smaller input, and really the S&P 500 is a quantitative sort for quality because you have to produce earnings in a, you know, if you're being added to it in the most recent quarter and over the trailing 12 months. So among other factors, you're going to have to be delivering the goods. So it does matter. But does it determine the outcome? I mean, I make this point all the time, that a lot of software stocks beat and raised using the lingo of Wall Street, meaning they outperformed expectations and they raised their guidance, you know, looking ahead, what do we expect to deliver? And like ServiceNow, I mean, they consistently pound the numbers. It's a terrific company, but go look at it. So, you know, so it demonstrates that fundamentals are an input, but certainly not the most important one anymore. And you could look at the AI trade. I mean, they're consuming capital at a staggering rate. I heard Saul Trujillo. He's a long time. He was a telecoms executive, very accomplished guy. And he said, you know what you should be looking at. It was on CNBC yesterday. He said, don't look at the capital investment that is being made. Look at the capacity of the market to consume the product that they're producing. What is the capacity of the market? Well, you know, we're very careful about our AI expenditures. We have an enterprise Copilot license from Microsoft that we use. We use it broadly, but we don't pay very much for it, and we're not gonna. And we've seen a lot of people cut back their expenditures on AI. It can very rapidly run up your costs. And so if these firms are, investing all this capital, but then the consuming market is saying it's already a commodity to some extent, at some point there's going to be a mismatch there, it seems to me. Anyway, Agreed. But there, so the point of that is, are the fundamentals great in that group? For some of them, but not for all of them. Okay, well, let's wrap up. Good to see everybody. Yeah, well, we'll do it again next week. We'll see where we are. Nice to see you, Steve, Barry, Brad. Thank you, Dan. Thank you. Good to see you guys.
Take care, Tim.
Thanks, Tim.
You too. Thank you.